Welcome to another Biddles Investment Group production. I'm going to try to be brief today. There's the shirt, Think Big, Dream Big. Can't see it very well, but that is what we are about. Thinking big, dreaming big. I want to give a shout out to @MarkManning-04W for recommending this video idea. So appreciate you for watching the videos. And I'm going to go ahead and get started. I'm going to share my screen. We'll jump into the presentation. And I thank you all for being with me. I'm going to try to be fast today. Let's get to the top of the presentation. So I'm not sure which screen you guys are seeing. So let me stop share. Let me share this screen here. All right, and we can move me right there, so I'm right there with you. All right, so market crash, recovery dynamics, how to spot it, and position yourself. So we did have, again, at Mark Manning, I appreciate you, and this is basically what we're going to cover. We'll cover a little bit of the psychology behind it, and then we'll try to do some charting. I get excited with the charting, so I'll probably have to do a separate video. But let's go ahead and get started. Let's set the scene. Everyone talks about crashes, but how do markets recover? So, great question posed. Let's break down the sides, timelines, and how we're going to position ourselves. So let's take into consideration the psychology of a recovery. There are crash emotions that run high. There's fear, there's panic, there's capitulation. Then there are recovery emotions, which is this really happening? So we're disbelieving it. Then there's hope. And say, okay, it could be really happening. And there's cautious optimism, like the past 2 weeks. We have a bit of cautious optimism in the investment group, which you are definitely invited to. We have it weekly every Saturday. But there's cautious optimism in the market because of the volatility and that it's become very reactionary from news sources. Uh, Behavioral finance. So we dig a little bit into loss aversion and we will define these terms for you, and recency bias. But for the most part, you probably understand the crash and the recovery type emotions. So psychology of a recovery. There's loss aversion. So investors feel the pain of losses 2 times more than the pleasure of gains, which causes panic selling during downturns. So if you got twice the loss, you're like, I gotta stop the bleeding. And then once you sell, you've accepted that loss. But long as you hold, you haven't accepted the loss. And then I recommend putting stop losses on so you don't get to a 2 times loss. Depending on your risk tolerance, we usually use between 4 to 8%ish, depending on what the trade is and how the stock trades, the volatility, the ATR, etc. Recency bias. People expect recent events to continue. And so I think that's a little bit what we have now. We expect that any negative news will shake the market, any positive news probably boost the market. The market will keep crashing, which clouds judgment about recovery potential. And then there's herd mentality. This is what we definitely want you to avoid. We want to position you correctly. Investors often follow what others are doing instead of thinking independently, leading to buying at the top or selling at the bottom. And so there is a strategy that we can employ, and then we can even maximize that strategy, and I'll share that with you. So if we go further into risk aversion, there's a flight to safety. During volatile markets, investors shift from stocks to bonds, cash, or gold, reducing exposure to perceived risk. In our market today, gold has taken off. A few weeks ago, I believe there was somewhat of a liquidity crisis as usually bonds will have an inverse relationship to the stock market. And so as the market went up, people will fly to safety, which are bonds. That means the bond ETFs will go up. But I noticed that as the market was falling, the bond ETFs, they went down as well. And so I did read a story from a Canadian journal, and it talked about not Justin, but the new Prime Minister, Mark, and how he got with some foreign nations, and they started to sell bonds, U.S. bonds, and so that was a strategy that they employed, and it was shaking the markets, and so everybody was pushing all that money into gold. If you look at a gold chart today, gold is up like 24% on the year. It's amazing. So we definitely want to get into opportunities like that. I don't think anybody really saw that coming. And if you did, kudos to you. You're sitting really nicely as this market has fallen to a negative tune. So reduced appetite for risk assets. Even after the market starts recovering, people remain cautious about re-entering high-risk sectors like tech or emerging markets. Um, and so they'll stay in bonds, they'll stay in defensive utilities, consumer staples, um, areas like that where it's fairly safe. Uh, Missed opportunities. Excessive risk aversion causes investors to stay on the sidelines too long, missing the early stages of a recovery where the returns are the strongest. And we had some really strong returns. I think we bounced back about 10% this week. So if you were scared on the sidelines, you probably missed a little 10% this week. The prior 2 weeks, I'm sorry. There's a nice uptrend. We can measure it out. So how to spot a recovery in real time. There's a volume surge on green days, and this is going to equate to institutional buying. The VIX will decline, which we saw in the past 2 weeks. The VIX went from like some crazy number, might have been 50, 60, but we can look at it. We'll make sure we know what the numbers are, all the way down to, I think it's around 30 or below 30 right now. We can take a look. Breath indicators improving. I believe there was a breath event April 24th where it was more positive or bullish. And so that breath indicator did occur April 24th, and we saw 2 weeks following that breath indicator of good gains. There will be and that just means more stocks are rising. There'll be a break of a downtrend, which means higher highs and higher lows. And we can see that on chart action where there'll be higher highs and higher lows. I can explain that to you. So let me take a note here. I'll explain that. And we'll take a look at the VIX. And we'll take a look at the 2 past weeks of what the market did, just to make a note. I don't want to promise you something and not deliver it. So what do we do as a retail investor? I know you've probably heard this dollar cost average backhand, gradual reentry. You want to watch the sector rotation from defensive to growth. You don't want to have a fear of missing out. Recoveries are often jagged. And so we'll take a note of that and I'll show you what it means by jagged. It's very simple. So we want to develop a strategy, which you can do on the call that we have every Saturday. We've got experts on that call. It's called the Wealth Builders Collective now, and it's absolutely amazing. So you definitely got to get plugged in. We want to stick to your strategy and don't try to time the bottom. We've got people with various strategies on there. As I make videos, I'll cover various strategies. I think I do have one video where we're using the stock screener that we've created, and we dive into a support resistance strategy and a cut pattern, which is my favorite strategy. So let's look at these shapes here. We got a V shape, which is a fast crash and fast recovery. So that's 2020 COVID. We'll take a look at that. We have a U shape, slow bottom and gradual rise. 2001, so that's the dot-com bubble. We covered that in the previous video. Go take a look. We do some historical comparisons of today and previous market crashes. And so we're not in a crash. This was a big correction that entered bear territory as far as where we are now, but we have pretty much recovered, and we're probably in correctional, semi-correctional territory. There's a W-shaped false recovery before final. So you get that W, then it goes down, and then it comes back up. Um, and that's that false recovery. So that's post 2008. And then there's an L-shaped, long, flat drag Japan post 90s. We'll take a look. Here are some shapes. So we have the V shape, we have the U shape, we have the W, and we have that L shape. And we'll start to look at some indexes. We just want to take you through history real quick. We've got a huge Dow bull market and a subsequent crash in 1982 to 1987. So this thing was off to the races, and then boom, hit that drop, 40% decline. And so we've got a little chart here. I won't go too much into it. There's a little commentary, but this was the week that Black Monday happened. 22.6% that put it into bear market territory over that first few days. The Fed was doing a few things over here. You can check that out, and you can see how the market recovered. Recovery from the crash that we just looked at. So we saw those candles, they come all the way down. And then we've got this slow uptrend right here. Um, kind of a V. It's one of my cup patterns that I would definitely like. This is 87. So now we've got same Black Monday, and you see that recovery, which kind of looks like an L shape. So that kind of looks like a very slow L-shaped recovery as well. This one is, I think this one is the NASDAQ or S&P. So some of these are different indexes. Go check them out for yourself. Here's the NASDAQ, so that definitely looks like an L-shaped recovery, but they say that that recovery from 2000 is a U-shape, but this looks more like an L-shape to me. Then we have the S&P. This is 2000 again. We can kind of see, okay, we got a little bit of the U shape here. So that is my cup pattern, but you can see it fully on right here. All right. And we've got the dot-com bubble. They say that this one is U shape. And we can see that U. So 4 years to recover to the same level. So that's pretty brutal. 50% crash in 2 years because of internet bubble. And then we have the financial crisis here, 42% in 1 year because of unregulated financial institutions. And we don't see the end yet. We can see 2008. They say this is a W-shaped recovery. I had a little hard time finding that W shape, but this does look like my cup pattern that I would like to get into. I don't probably need a little bit more data after 2010 to see that rise and that cup fill out though. This one here is the Nikkei, so Japan's post 90s L shape. They just went down, 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 down. But eventually this U, I feel like that's a big U right there. That pulled into play. Once we rose above this level here and made a higher high, we were off to the races there in Japan. Now, I want to implore you to go visit and international ETFs. The international market is doing really good right now. Pre-COVID, we can see that quick V recovery, COVID-19 crash, and then the post-COVID rise there. So just some information here. So let's do a little bit of charting for live examples of these recoveries. We're going to take this down. Let's see if we can exit this. All right, so this is the S&P that you see before you. Hopefully you can see this screen. Hopefully I'm recording the screens right. But cool chart. Found this on macro trends here. This is you can see the recessions there. So in gray, you'll see if we put show recessions, we've got the recessions there, and you can go 30 years, you can go all years, you can see all the recessions that have happened over time. I think we're on the 30-year chart or the 20-year. So we can see 2000, we can see the financial crisis, and then we can see COVID, which was very small. You can see that V right there. Um, let's see right here. Let's go to 10 years. Let's go to 20. We'll see that V right there. Boom, boom. We can see 2000. If we go to 30 years, we'll see kind of a V shape or U-shaped. And then if we look at the financial crisis over here, they say this is like a W here, which that was, we rose and then fell. So that was kind of like a fake out right there. So I can see the W shape a little bit, sloppy W, but I can see that. So that is charting. And let me look at what we have here. So I was going to explain to you higher highs. And so if we look at the S&P right here, you can see that there's a low, and then the next low is higher than the previous low. There's a high here, and the next high before it pulls back, which we could even go here, the next high is higher. So this is higher highs and lower lows, or higher lows. Uh, and so a parallel channel is something I did want to show you all because you can get a better price. So even if we're dollar cost averaging, um, let me grab a security here. Let's just say Sprouts Farmers Markets. So we got a little bit of data over here on the weekly. So we got weekly over here, daily over here, and I don't like this chart, but give you an example of how you can use parallel channels. So we click that parallel channel there. We can draw it at the lows, okay? Then we go up to where the highs keep hitting. So that was a breakout. But basically, and you would get a better better chart than this. But this is okay if we blow it up. So you can see in that parallel channel, we can pull that down, boom, boom. Once we create our channel, we know it's going to act like a ball and it's going to hit the sides of the channel, boom, going up, sides of the channel, boom, going up. So you're going to have a higher price point to get in at, but we want to wait for the pullback. So for example, if we're dollar cost averaging and we know how to chart, then I can do two things. I can enter if I drew this channel and I know, and I'll have to connect the bottom part. I'm just trying to show you very quickly. But if we know it's going to bounce and pull back, we know at some point, it could be a fast pullback or a slow pullback, but we know that we can get in somewhere in this area. And then, so we can set a low limit order. Maybe we put it at, what, 63.19. But we got that. Then I really don't like this chart. This isn't the greatest example, so I gotta go find another chart for y'all. I gotta go find another chart for you. Let's do Palantir. Okay, so this is probably better. A little bit, still very volatile, but what I'm trying to demonstrate here is if you know charting, you can get in at that price point. You can get in at that price point, right? And so instead of just DCAing in, you might be DCAing at the highest price points, and then you notice that the stock pulls back, and you're like, man, I've been DCAing, but I'm still at a loss. This is why, because we need to get the charts and we need to understand what the best price is so that you can take some of that loss or get some of that risk out. And this is how we can find those best prices. And it even works in ranges. So Intuit, for example, I know this one, it used to be a range bound. I haven't looked at it in a while, but we can see here. Yeah, this is nice. Very nice. Look at this. Check this out. Let's say we was like all about Intuit and we like, okay, we like Intuit. We see that in this box or range that we've drawn out, and you can ignore this little box here and ignore, just try to look at that blue box. What I'm going to draw for you is, boom, here's an entry. You know it's going to hit that bottom. You have confidence in that bottom. Look how many times it hit that bottom. See that? And so if we DCA, we know, look at this, boom, 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 boom. This whole week, it hit that price point, 597. And so we know 597, 600 is our price point. We can set a limit order, good till cancel, good for however many days if you got customization. And if we're getting close to that price point, let's set that limit order. Let's scoop it up at that good price. Yeah, we may go lower here, boom, 561, but we can do half a position and another half at 561, okay? Just in case we do go lower. Or we could just bounce like we did here, boom, bounced all the way up. And so we keep getting it at that good price. Um, it'll position us to be have a lower loss or be up more because this one is still, we would have been up, but we would have definitely had to keep DCA at this $600 price. Somewhere give $5, give or take 595 to 605 price, right? And then now we will have a small profit because it's sitting at 631. So if we DCA and add that strategy, boom, we've increased our returns by more than the average. Now, if you just want to sit in and forget it, it's fine. You could do that. But we want to try to maximize even by 1%, 2 percentage points. We want to maximize everything we can in this market, especially with the volatility we've been experiencing today. So hopefully I didn't take up too much time. We're going to jump back into the presentation. Just got a few things to wrap up, and then what did I say? I said we would look at the VIX. So I just wanted to give y'all a kind of an example there. Get excited with the charts. We're gonna look at the VIX here. Yeah, we were at 60. Boom. Well, that was 1, 2, 3, 4 weeks ago. We were at 60, and then a few weeks ago we were at 35, and then 32. So I embellished a little bit. Now we're sitting at 25, below 25, 22, which is the range that I was used to between 15 and 20. And then we hit that 20 to 25 range. But this is a lot safer here. And then we were going to show you jagged and the 2 past weeks of the indexes. So jagged just means that when it says stocks are jagged, DCA, it just means they go up and down, up and down, up and down. You really don't know what price you're going to get in. But if we see that there's a channel or a range, and we can draw that, then we can at least set ourselves up or position ourselves to get in at a good price. See that double top? Great predictor of this huge fall right here. But I'm gonna measure out how much we fell. So we fell all the way down. You see that small, all the way here. So this is about 18%. Make sure yeah, I got it all. It's about 18% there. But we recovered in the last 4 weeks. In the last 4 weeks, we recovered 13%. So if you were in the last 4 weeks, we recover that amount. And then if we use our strategy on the daily, let's say this is something that we were trading, this thing hit multiple price points at the bottom. Um, This is why it's important chart. And this looks like the multiple price points. This thing pulled up and then pulled back. So on a weekly level, we were pulling up. I gotta move this stuff. We pulled up 6% and we pulled back 6%. You know, uh, so we were pulling up, pulling back. Once we saw this gap, so we know the price is going to land down there to fill that gap. That price landed there to fill that gap. So that gives us an indicator of where the price could land because all gaps usually are going to fill. We don't know what time they're going to fill, but they usually will fill. And so boom, we got a confirmed price. Now we got a gap price, confirmed price. Now the next time this thing hits that price, we could take advantage of it. So you could took advantage of it here. You might have got bounced out here if you didn't have a stop loss, but if you had a big enough stop loss, so let's see what that is. It's 1%. So you wouldn't have got bounced out there potentially. This is an index, so 1% is fairly, it's a nice amount. But we had a 3% stop loss. We said, hey, we definitely don't want to lose this 3%. Okay. Then we're still in that trade. We can ride that thing up to the next resistance level. So we probably thought this was a prior resistance here, but we saw it set another level. So anywhere between that level, you want to start to scale out. You can stay in the trade, uh, but start to scale out of that trade to secure your profits. And then you hit that level, which is the resistance level. We know we're going back down. We set our limit orders down at the bottom. We got to be patient. This took about 1, 2, 3, 4 weeks. Be patient. And so even if we DCA, boom, we got the best price for DCA. Even if we went to the middle and you missed it, we still got the best price, a better price than just kind of blindly DCN. I mean, you can do it, set a schedule, you can set it and forget it. So I get that. But if you're interested in charts, how to read these things, they're really amazing. They give you a lot of information. And so one last thing, we covered the 2 past weeks. So that was all the charting that I wanted to do today. I will do a charting video. You can see my charts are mocked up crazy. Um, we measured that out. We take a look at gold, which you see has been crazy. Um, just crazy going. And I can measure that out since 2025 here. We'll measure that. That's about, we landed here. So we got a 20% return on gold. And we see these, you see all that parallel channel, boom, hit there. It didn't hit all the time. Sometimes it'll hit the middle of the channel, and you can draw another channel within the channel. You just grab that, boom, because you can see we'll hit this, and we'll go to the middle, boom. Or, they might have other technical indicators that draw you a channel. I think Fibonacci draw the channel, so to speak. But you can see that this thing hits, hit that middle, bam, bam, bam. So those are the prices I want because, my profit is going to be greater. So if we can position ourselves, we can recognize the pattern. You got to be quick sometimes, though. It might not be consistent, but 4, 3, 4, 5 times, and then different price could be set. And with this market, we don't know. So I appreciate you. We're going to jump back into the presentation. I did promise you that. We want to get the key takeaways. So dollar cost averaging. Gradually re-enter the market by dollar cost averaging. This strategy involves investing a fixed amount of money, so 25 bucks every week, at regular intervals, regardless of market condition. Is going to help mitigate the impact of market volatility. Is going to reduce the risk of making poor investment decisions based on short-term market movements. Palantir has been good. Nvidia has been good, but if you have no idea what to invest in, um, I tell all of my friends or family or clients that you look at where people shop at, look at what your friends are buying, look at the parking lots, look at is everybody using DoorDash? Is everybody Uber? Let's figure, let's think about these things and come to a conclusion and say, hey, that might be good. Is everybody on Reddit? Is everybody going to the dollar store right now because they're trying to save money? So we just want to put some of those things into play. If we think about it, we can start to figure out some areas that we would like to invest in. Watch for the sector rotation. So we want to keep an eye on sector rotation during market recoveries. Different sectors may perform better at different times. For example, defensive sectors like utilities and consumer staples, we talked about that earlier, may lead during the early stages of recovery, while growth sectors like tech and consumer discretionary may take the lead at later stages. We want to avoid fear of missing out. So market recoveries are often jagged. We saw jagged, that up and down action. That's jagged and unpredictable. And it's important to stick to a well thought out investment strategy rather than chasing short-term gains. We want to stick to your strategy. You don't have one. There's many strategies. You can Google strategies. We've got fantastic strategies in our Saturday call. So you want to have clear rules. You want to develop your strategy. You want to understand what goals you have. We have an investing video here. Just watch that. It's gonna you'll understand your risk tolerance. You'll understand what goals you have for investing. Like this is stuff you have to think about because if we want to be wealth oriented, if we want to think big, dream big, and we want to provide for future generations, we definitely have to make sure to do our part. And it just takes a little bit of thinking and development. And once you have it, you know what you're saving for. Maybe marriage, maybe a wedding, maybe a vacation, maybe for retirement. So we can set different accounts and invest different strategies to get you where you want to be at. So then we don't have to go into debt or realize that once we come back from vacation, you're like, man, I know I didn't spend that much because I know that's happened to me a few times and I did spend that much. But the investment strategy is there so that you can pull from that money, not have to use the debt. Um, you get what I'm saying. Final thoughts. So we got market crashes are loud, recoveries are subtle but powerful. Listen to our market summaries or register for the live market review sessions. Get tools, dashboards, and strategy tips via our email list. I appreciate a lot of you have been signing up. So we're going to send out a monthly newsletter this month. So thank you so much. And then subscribe and please share with other people the YouTube channel. So we'll play that. Biddles Investment Group. I appreciate your time. I probably went way too long. I'm trying to cut these things to like 10 minutes, 20 minutes, but I get to going. Think big, dream big. I appreciate you. I hope you learned a little bit today how to spot these recoveries. I didn't get too much into my cut patterns, but my cut patterns are similar to some of these recovery setups, and I'll do a video to show you how I identified the cut pattern setup. It'll be about 10 minutes, so we'll get you in and out next time, I promise. Until then, happy trading, and I appreciate you, and thanks for your time.